All right. Well, top of the day, everyone. Morning, afternoon, and evening. I am Lieutenant Commander Ayeni calling you from awesome nation's capital. And today we are going to talk about healthcare finance. Well, first of all, congratulations on this milestone. You're almost there. Really proud of you. And I know the feeling, anxiety, happiness, studiness, and everything that goes with taking a BOG exam. But you're going to do great. Why? Because you put in the time and effort into being great and you will pass the exam. So without further ado, we'll go right into the topic. I'm on slide number 2. And our learning agenda today and our journey of learning is going to be on financial knowledge, which is about 12% of the BOG exam questions. So that's about 24 questions. Keeping in mind that the BOG exam is weighted, as we already know. So the goal is to try to just answer as many questions as you can and the best way you can, as soon as you can, with the knowledge you have already in your that you're familiar with. So today we're going to cover basic accounting principles, and then we'll talk about financial management and financial analysis principles. Then we'll talk about operating budget principles, capital budget principles. We'll talk about some reimbursement methods, financial controls and auditing principles, capital funding sources, revenue generation, and then we'll round out with asset management and then do some Q&A at the end. And what I try to do to break the myth of the finance portion of this exam is to try to relate it as best as I possibly can to our personal finance or the finance within our respective MTFs and organizations we serve as well. So moving right along to slide number 3. So with basic accounting principles, essentially, with financial accounting, and just like with our checkbook, right, our bank account is all about involving how we identify, how do we record, and how do we communicate the operational results and status of our organization, right? In the sense that the financial statement, so it is a balance sheet, statement of operating, statement of operations. Uh, Essentially, that summarizes and communicates what an organization's financial status looks like to your interested stakeholders, both outside and inside the organization, right? And essentially, the financial statement it essentially predicts the health of the organization, if I can say that, like the financial condition. When you look at a financial statement, which we're going to do here together shortly, you'll see how it all relates and how from looking at it, you can tell whether it's a good, bad, or to be good financial condition. And when we talk about stakeholders, we're talking about investors, talking about the board of directors, managers, and of course, the most importantly, our workers within the organization. Okay, we go to slide number 4. So, with financial accounting, again, it's conveyed by the business financial statements, right? And we're going to talk about the 3 most important financial statements, which is or are the income statement, right? So every 30 days or about, we get a statement in our bank account, or we get a checking account statement or savings account statement. Pretty much the same thing, very similar. And we get the balance sheet, right? And then we have the statement of cash flows, which is exactly what it means. It's a statement of cash and how cash flows through the organization. Okay. All right, so going to slide number 5. So it is imperative that we understand the role of the SEC, right? So we cannot talk about finance and financial regulation and financial authorities without talking about how the Security Exchange Commission plays a significant role in regulating financial transactions and organizations and anything finance in the United States of America. And essentially, it is and it has the legal authority to regulate the form and content of financial statements. So everything we see on an organization's financial statement, i.e., the income statement, right, the balance sheet, and the statement of cash flows, all the information you see on those 3 specific or three most important forms of financial statement is all regulated by the Security and Exchange Commission. And they're able to do that through the organizations, the following organizations, which are the Financial Accounting Standards Board, the FASB, right? Then you have your AICPA, which is your Industry Committees of American Institute of Certified Public Accountants. It's all about what the public accountants say through the Financial Accounting Standards Board, and of course, our Healthcare Financial Management Association as well. Okay, moving on to slide number 6. So, in essence, for the financial statement to be prepared, it follows the GAAP, right? So the GAAP, the General Acceptable Accounting Principle, is established by the Financial Accounting Standards Board. So as long as you're in the United States of America, you're a firm that operates in America, and you have a balance sheet, an income statement, or a statement of cash flows, you will execute in accordance with the FASB, Financial Accounting Standard Board, the GAAP principle, which is generally accepted or generally acceptable accounting principles. And it only applies to the financial accounting statements. Okay. So again, your statement of cash flow, your income statement, and your balance sheet. Okay. Moving on to slide number 7. And here we're just talking about just the following concepts that provide overall basis to prepare financial information. They want to talk about the accounting entity, so what's the name of the firm, what's the going concern, meaning what are the ongoing issues or the ongoing financial efforts of the firm. We'll talk about the accounting period. And this is a good one to know because for us in government, right, our accounting period, as we know, well, I'm not going to presume, but it's mostly fiscal year, right? So our fiscal year is from October 1st, right, to September 30th, right? That's our accounting year, or our year of accounting period. But of course, for the civilian firms, some have do January to December. Some folks do April to May, April of the previous year to May of the following year. So again, the balance sheet has to show that period. It has to account for the accounting period, right? They have the objectivity and relativity, or reliability rather. So all the numbers and the information on the financial statement has to be definitely objective and reliable. The monetary unit has to show, so whether you're using dollar, the pound sterling, euro, yen, you have to have that on the financial statement. It has to be relevant to the firm, relevant to the company's business. And then, of course, you must have full disclosure, and that's normally found at the bottom of the financial statement. You see the full disclosure of what the firm chooses to disclose in relation to the numbers that are being presented on the financial statement. And then you have your materiality, conservatism, and of course it has to be consistent. The numbers that reflect on a financial statement has to be consistent and comparable to ensure that it remains relevant to what the firm actually does to interpret its business financially. Okay, so we're going to go to slide number 8. So here we're going to talk about the principle of cash versus accrual accounting. And for most of our businesses, essentially cash transaction is cash accounting is exactly cash transaction, which is the statement of cash flows. That's where you see that reflected. It's simple and easy. It pretty much very similar to a tax statement, but the way you see your cash accounts reflected is on the statement of cash flows. And then, of course, your accrual accounting is pretty much what we use, and I use the word we as a collective. Most firms in America, government or civilian, that really doesn't. It is applicable to both. We do an accrual form of accounting, and with accrual form of accounting, the best way to know this is the matching principle. So when we look at our bank account or our bank statement, for every debit there's a credit, right? Well, for the most part, when we look at an organization statement, for every debit there's a credit that matches exactly how that money is taken out of the account and where is it spent to show where it's credited in the account, right? And that's what's called the matching principle, which is what we're going to talk about a little later. But the accrual accounting, when an obligation is created, it shows that, right? And of course, is required by GAAP. So again, remember the general acceptable accounting principle, which is by the Financial Accounting Standards Board, FASB, right? Which SEC relies upon, right? All monitor, right? The monitor or to provide a true economic status of a business as required by GAAP. So that's how it's all connected. How accrual accounting, you make that obligation and you see where it matches on the financial statements and is regulated by GAAP. Okay. All right. So going to slide number 9. So as I mentioned previously, when you think accrual accounting, you're talking about that matching principle, right? That matching principle means for every debit, there's a credit, right? For every revenue, right? The revenue must be matched with the accounting period that is earned, right? So when we talk about the statement of cash flows, or when we talk about if we're taking some concept from slide 7, when we talk about the consistency and comparability, right? That's what we're talking about. Where your revenue, whenever you make money, you make that income that comes into the organization. It has to be within that accounting period, and more importantly, it has to match the expense, right? So whatever expenses is made, the revenue that is made of that expense must match. And that's what accrual accounting is all about, which again, it is required by the GAAP, the generally acceptable accounting principle. Okay, we'll go to slide number 10. All right, now we're getting into the first financial statement, which is the income statement. And again, akin to our checking account, savings account, we get a statement, a bank account statement. The income statement, somewhat similar, where it provides information about a business operation and economic profitability. So essentially, on the income statement, sometimes it's called a statement of operations. Sometimes it's called a statement of activities. It's the same thing. And what it is on the statement, it will show the accounting period. It has 3 elements, right? In those 3 elements, you have your revenue, right? And the revenue pretty much shows both the cash. It represents both cash received and payer obligations. So the first item is your revenue, and then right underneath your revenue is your expenses, right? Which shows the resource that you expended during that time. Again, you note under accrual accounting, there's a match, right? So revenue, expenses, and of course, it gives you the net income, which is also known as the profit, right? So the most important thing about the bottom line, right, of the income statement is also your equity section of the balance sheet. And we're going to see how that flows here shortly. So your income statement, again, 3 components: your revenue, right, your expenses, and of course your net income, also known as profit. So if we go to slide number 11, right? So on slide 11, this is a pictorial representation of what the income statement for Humana, actually, Humana Inc., which is one of our subsidiaries for healthcare. So here you can see, again, when we talk about the accounting period, so at the very first line, it tells you this accounting period ended in 2015, 14, and 13, respectively. It shows you the total revenue. It was about $54 million in 2015, on or about, right? And then it shows us the cost of the revenue, right? So that's the expenses right there. So that's the first cost you see is about $44 million, right? And then it gives that gross profit, right, which is about $10 million. And then it further deduces or deducts expenses, where we have the other, about $7 million. So your operating income or loss is at $2.3 million for 2015, right? And then it now gives you some line-by-line itemized expenses from, income from continuing operations, total other income expenses, interest expense, income before tax, income tax expense, and so on. And it's itemized until you see the net income, which is about $1.2 million on or about. So the net income that's applicable to shares, to common shares, is about 1.2 million. And that's essentially a pictorial version of what an income statement looks like. All right. Okay. Now, keeping in mind that the net income, right? So the very last line, that $1.2 million, is going to translate over to the equity section of the balance sheet, which we'll talk about here shortly. Okay. So moving on to slide number 12. All right. So the balance sheet. So what makes the balance sheet very unique is that it's a snapshot of a point in time, right? So your balance sheet usually shows you what your firm looks like at the end of the year for most balance sheets. It's usually the end of the fiscal year or at the end of the calendar year. And essentially, it's a basic format. You have you're identifying, it highlights your assets. So you take your assets, what you have, you take your liabilities, what's out there, what you owe, and then equals the equity or residual. So when you look at assets, what are we talking about? We're talking about cash. Other assets are expected to be converted to cash as quickly as possible. So whether it's marketable securities, whether it's your net patient account receivable, your inventory, what you can convert to cash is also called an asset. And for a firm's liquidity, the ability for a firm to quickly convert assets to cash is something that stakeholders, investors really value. So when you look at your net working capital, which is your current assets minus current liabilities, investors really look at that to see how the liquidity or the high value of that organization and how well they do when it comes to the health of their finance. Okay, so let's go to slide number 13. So as I mentioned earlier, your current liability. So we talk about current assets. So your current liabilities are those obligations that come due. That it has to be paid, must be paid within the year of the accounting period. And most of our common liabilities include, notes payable, your accounts payable, your accrued expenses. So when you take your assets, right, or current assets, you deduct your current liabilities, you have that equity, right? So equity essentially is that the non-liability claims against the business assets. So if you're an investor-owned company, a firm, or a for-profit organization, a hospital, is the amount of owner-supplied financing, right? And then for nonprofit, of course, equity is the amount of capital supplied by the community per se. So again, equity is also the residual, right? So total assets minus total liabilities, or current assets minus current liabilities, that's your equity. And when we go to slide 14, on slide 14, again, we get a pictorial view just to take it, put it in a concrete, take it out of abstract. So here you have a balance sheet that ends in the period, again, of 2014, 15, 14, and 13, respectively. So here it tells you the period that it ends, again, following that general acceptable accounting principle, GAAP. So SEC mandates how this information is presented through the GAAP principle, which is regulated by FASB, right, the Financial Accounting Standard Board. So here with your asset, you can see with the current assets, it lists out what current assets this firm has. You have your cash and cash equivalents, you have your short-term investments, your net receivables, inventory. So right there, you see that cash equivalent is about $2 million, 2.5 or about. Your net receivables is about 1.161. So you have your total current assets. So here it talks about your long-term investments, property, plant, and equipment, which we'll talk about later. You have your goodwill, which we'll cover a little later. Or if you have any question about goodwill, I can answer that now as well. You have your intangible assets, accumulated amortization. So essentially on this balance sheet, you can see the total assets, comes to about $24 million. And then it also reflects the total liabilities, right? So on the total liabilities, it gives the long-term debt, it gives the other liabilities that are out there, and it talks about stockholder. And once you get total liabilities, then you do your deduction when it comes to what are the other earnings that are out there as far as miscellaneous stocks, preferred stock, common stock, etc. And at the very bottom is your total stockholder equity, which is about $10 million. So when the deduction is done, at the bottom line of this firm, they want to have a net tangible asset, which is their final number at the bottom of their sheet, right? But the three basic principles for your balance sheet, again, is your assets, current asset, total current assets, minus your liabilities, which gives you your equity or your residual. Okay. All right. Slide number 15. So the third financial statement we'll talk about is a statement of cash flow. And like it says, it is cash. So that's where any cash that goes or flows through the organization goes under statement of cash flow. And essentially, the cash flow from your operations or operating, your investing, and your financing activities. And what it does, it converts the net income based on accrual accounting to a cash basis by adding non-cash expenses back into the reported net income of the organization. So when we go on slide 16, again, giving you a pictorial view, here you can see again the matching and the gap principle of showing that this statement of cash flow ended on December 31st, 2015. And of course, it gives you the net income, right? So remember, we get that net income from the income statement. So that's why it says net income right there. And then now you have your three operations from where the cash flow came from. So your first section is your operating activities, right? And it gives you the different aspects of those operating activities. And you see the total comes down to a little over $860,000. And then the next section is your investing activities. So all the cash from the investing activities, it gives you your total over there about a little under $320,000. And then it talks about, of course, financing activities. So those are the three components of your statement of cash flow. Again, your operating activities, your investing activities, and your financing activities, which ultimately you have your total change in cash and cash equivalents. So that's the pictorial and the three aspects of your statement of cash flow. So again, remember, your income statement is exactly what it is: revenue, deduct expense, you have your net income, right? And then you bring that over, your net income comes over to your statement of cash flow, where you see the cash from financing activities, the cash from operating activities, and the cash from investment activities also reflected there. And then when you go on your balance sheet, you have your total assets minus total liabilities, which gives you your total equity or stockholder equity, or also known as residual. Okay. So those are the three, those are financial statements and the three most important ones we just covered. So on slide 16 and onward, we're going to talk about the activity ratios. And really for activity ratios, it's not necessarily to know how to do the formula. I believe, on the exam, if I'm not mistaken, and Tracy, correct me if I'm wrong, or if anyone has heard anything different, please chime in as well. The intent is to understand the meaning of the ratios themselves, right? So when we talk about, for the first one, a total asset turnover, essentially when you have that figure and you benchmarked against the industry, you're measuring how the efficiency of the organization's asset to produce revenue. So out of all the total asset you have, or out of your total revenue, you divide that by your total asset. And of course, based on the figure, we determine to the stakeholder investor, like, oh man, they do a sucky job being efficient in their revenue. Or wow, for every dollar they spend, look at how much revenue they make. This is a firm we want to definitely invest in. So same thing with inventory turnover, right? Exactly is measuring how effective do we use a inventory. And here you're looking at taking your total operating revenue and you divide that by your inventory cost, and the figure when measured to industry standard of the market that the investor is trying to penetrate into would determine if the organization is valuable, or how much stock they hold on shelf, if indeed they're going to move forward to invest in that firm, right? So again, with fixed asset turnover, again, as I say, it is fixed. So here we're talking about buildings, plant, equipment, as such. So you're looking at the total revenue of the organization, and you divide that by the cost of those fixed assets. The net plant and equipment. And again, it measures the number of dollars generated for each money or each dollar invested in buying that plant or equipment. How much money are we generating for the money we spend to buy this fixed asset, right? Okay, slide number 18. So that was activity ratio. So now we're going to go into the liquidity ratio. And again, liquidity ratio, as it says, is about how well the organization is positioned to meet short-term obligations, right? So whenever someone talks about liquid, just think about water. How quick can I drink water? How quick, water is fluid. So how quick can you convert that money to cash? How quick can you convert and meet your short-term obligations? So here, when you talk about current ratio, essentially you're taking the current assets divided by current liabilities, and that shows the investor how much you can your proportion of asset to liabilities and how you can easily pay your debt. So it's just like applying for credit, right? To me, it's akin to the net. What do we call that on a credit report? Income debt to income ratio, pretty much. That's pretty much what this ratio reminds me of, right? So when you look at your asset test ratio, I mean, here's a little bit more complicated math, but it's the same thing. You're looking at how much cash you have, what are those securities you have in the stock market, are those marketable securities, and you divide it by current liabilities. And here's all about, again, how soon or how much cash and marketable securities do you have to pay off your current liabilities. So that means if the bank was to come with urgent, if you just sell the firm today, the intent is, okay, how soon can you meet the short-term obligation, clear out this debt, and still be profitable as an organization? And the same thing with days in account receivable. What you have in account receivable, you divide that by your patient revenue times 365 days of the year. And again, all that says is, hey, the money we have outstanding, or the money we have outstanding to be paid back to us, how soon can we get it back into the firm to pivot to invest in buying new equipment, or pivot to invest in expansion of bed capacity or a new service line as such. Okay, so those are liquidity ratios, liquidity measures or liquidity ratios. And again, remember, just like water, how soon can you meet that short-term obligation? That's pretty much what it's all about there. So moving on to slide number 19. So here we talk about operating ratios, right? And essentially, you're measuring the operating efficiency of the healthcare firm or the business organization. And essentially, so you're looking at operating income and you're dividing that by the total operating revenue when you talk about operational margin. And here you're trying to figure out, okay, what's the proportion of profit remaining after you subtract the total operating expense from the operating revenue, right? So once I take that revenue, subtract expenses, what's my profit? That's what I'm measuring this, right? So it's and the example it gives there is if a company if the figure comes to 12%, meaning you take your operating income divided by your operating revenue, all it's saying is before interest and taxes for every dollar, you're making 12 cents. So before you take out income, before you take out taxes, for every dollar that is in that firm's bank or that firm's account sheet or financial statement, they make 12 cents, right? And then your return on total assets is exactly what it says, the excess of the revenue over expense divided by your total asset. And again, comes down to how much profit is earned after each dollar is invested in assets. So your operating margin, of course, for an investor, yes, they want to see liquidity ratio. Yes, they want to see activity ratio, but the operating ratio really shows how efficient, right? What's the efficiency of that organization? You know, because I think, in my opinion, this is one of the ratios that really shows how effective your chief operating officer is. Is okay. Well, let's see how you operate and how lock and step are they with the CFO, the chief financial officer. Okay, I'm going to slide 20. So slide 20 talks about the capital structure ratios, and here we're trying to measure the amount of debt and equity required to support operations of an organization. So here you have your long-term debt to fixed asset ratio, where you're looking at, okay, how much long-term debt we have divided by the fixed asset, and essentially is how much debt, how much leverage is used to buy high capital fixed assets, such as buildings or equipment worth over $25,000 or $250,000, which is what we use or measure in the Navy and the military for say. So that ratio, pretty much how you're financing your debt for the assets that you have, right? Then the long-term debt to equity, the same thing, right? Remember equity, remember we take it from that financial statement, right? When you take if you look at your balance sheet, remember? So that's where that equity comes from. Is like how much debt over equity do we have for the organization, right? So once you take your total asset minus your total liability, you have that equity, correct? So you come over here and you say, okay, my long-term debt divided by equity, what is the long-term liability relative to fund all the balances I have in my account of the organization? And then, of course, the last one is the debt service charge. And here is just a matter of how soon or how long can I pay my debt back? How long can I pay back a loan? Like as a hospital, if I take out a loan, how soon can I pay it back given my financial picture? So here we look at, excess over revenue, over expenses, plus interest, plus depreciation, and then you divide it by your interest expense and your principal payment. Again, it's not most of the calculation, but understanding what the ratio means, right? That's the main thing here. Okay. All right. So we go to slide number 21. So on slide 21 here, we'll talk about managerial accounting. So we talk about financial management analysis. So for managerial accounting, this is where we use the organization and subunit data, and essentially is designed for managers. It's primarily forward-looking, so you're looking like in the out year, maybe a year or two out, and it does not adhere to external standards. So this is something that's internal to the organization itself, per se. The most important thing, one of the important things here is that cost is a critical element, or cost is a critical part of managerial accounting. So how you measure your cost is important, because the relation between the cost and the volume of services is what's called your cost behavior or your underlying cost structure, right? So here, when we talk about if you know your underlying cost structure, then you can forecast at different levels of patient volume. So here you can see, okay, fixed versus variable versus semi-fixed. The manager is able to forecast those cost measures based on the volume of patients that are coming through an organization. And if you go to slide 22, we'll take this out of the abstract and do some math, some basic math here, where pro forma is a company. You have the profit and loss statement, right? So the revenue can be added to cost behavior. So here we see where the total revenue is $100. They have a $75,000 patient volume. right? So 7.5 million, right? But the total variable cost is $28 out of $100. Their variable cost is $28.18, right? So that amounts to $2.1 million, right? And then the contributed margin, right? The delta is the remaining $71.82. Multiply that by the volume, you have a little over $5.3 million. And of course, your fixed cost is always fixed no matter what. So that could be maybe the light bill or the building mortgage or a fixed cost that no matter what, no matter the volume of patients, that's always going to be the throughput. So here you can see that the profit of the firm is at $419,000, right? And they have the break-even analysis, and essentially is the same thing. Here volume needed for a program to be self-sustainable financially. So you look at your total revenue minus your total variable cost minus your fixed cost. So it's essentially the same math you're doing. You're taking the $100 times 75,000 patients. You subtract the variable cost of $28 times 75,000 plus the $4.6 million or 4.9 million fixed cost, which gives you your break-even analysis at that point, right? Okay. Now we go to slide number 23. So on slide 23 here, we're going to start talking about the basic, the operating budget principles, right? And we're just going to talk about, just give you a quick overview here. The first one we'll talk about is your strategic plan. And for strategic plans, on average, is a 10-year outlook. With the way things are going, some folks, organizations start looking at bracketing that further finite, more like 5 to 10 years or 5 to 7 years, depending on what their glide scope looks like for the community per se, right? So here we want to talk about in your strategic plan. Of course, you're trying to validate your mission, assess the external environment, who's our competitors, what's going on out there, and at the same time you assess your internal environment to formulate the vision, establish your strategic thrust, what are those go after objectives for the organization that enable the strategic vision, informing the strategic plan, and what are your critical success factors, and then of course in that developing those core objectives and the strategic financial plan, which has to feed the strategic plan in itself as well. All right, go to slide 24. So here when we talk about the strategic financial plan, so your strategic plan is a 10-year outlook on average. Your financial plan is a 5-year look that forces the executive management to identify those resources required to accomplish the strategic plan. So here we're talking about, how much cash should the organization have? How much debt can we afford when we look at those debt to income ratios, right? What is the margin target necessary to meet our cash and debt levels? What's the required level of operation that should change to meet your marginal target? And, what's the source of capital funding? Are we going to do fundraisers, which some firm, not-for-profit organizations do that a lot? Are we going to borrow? Are we going to, sell off or close down or partner with a physician organization or hospitalist? And those are questions that the strategic financial plan, the executive management has to answer to inform the strategic financial plan, which is a 5-year outlook. And then, of course, you now have your operating plan, which translates the strategic plan into next year's objective, right, into your annual objective per se. Okay, we'll go to slide 25. So on slide number 25, so here we're talking about, the budget, right? So essentially, the budget really is essentially taking the operating plan and translating that to dollars or translating that to monetary terms. That's really what a budget is. And when you think about it, for us in government, when the president sends his budget to Congress, essentially he's taking the national security strategy and national defense strategy. Well, national security strategy for the most part, and all his campaign promises that he's made. And he's like, okay, I've sent you my budget Congress, which normally goes in this first Monday in February, per the law, supposedly, right? And that translates into the money that is asking Congress to pass. He or she is asking Congress to pass. So same thing with an organization. They take the operating plan because again, the budget is for 1 year, which makes sense. So the company is doing the operating plan for 1 year, and then I'll translate that budget into, okay, this is how much it's going to cost us to execute our operational plan, which should inform the strategic plan of the next 5 years, right? Strategic financial plan, which is rolled up to the strategic plan for the next 10 years. So that's how all that is connected. But on your budget, again, provides your financial transactions and other operational goals for each unit for at least a year, right? And is normally a top-down approach versus bottom-up, right? So when we go to slide number 26, on slide 26, it just provides, again, taken out of the abstract, it gives us a pictorial view of the different strengths and different techniques, the strengths and the weaknesses of each. So when we look at the incremental, right? So in essence here, you're using last year's budget as your baseline, right, for next year's effort or for the current year's effort. And I think, as we know, this is pretty much what we do in the military for the most part, or in government, is we look at last year's actuals as a starting point, plus or minus 3% for new programs. And then when we get into continuing resolution, which is what we're in right now, we are standing by because we cannot buy more or spend more than we spent this time last year, right? So here it's all about outputs, it's all about programs to be achieved, costed and benefits evaluated. I'm sorry, the strength of this is, is easy to do, good to go. The weakness is, of course, we're assuming last year's amount was the right subject. Arbitrary to cost focuses on inputs. Sometimes that's good and sometimes that's not so good, right? And then you have your program budget, in which is all program based and is all about the benefits to be evaluated. And essentially, it's all about the output, which includes input-output comparisons. So in government, how we do this is for like our 5-year money or our 3-year money. When we're trying to buy big size equipment items, or when we want to build our ships, or build our buildings, that's 5 year, right? So it's all about the program budget work schedule, which works out great. But then the weakness there is, for organizations, sometimes doesn't align with responsibility centers, or sometimes no one has responsibility because everyone has a program manager, but because every program has a manager, there's no one central program manager. So when something fails, you're like, who was in charge? Well, everybody was in charge, right? So it's that's why we had, for those of us that are familiar with Joint Strike Fighter jet, it was a multi-year, multi-acquisition method program, but there were many program managers. So when the first few years when it was failing, a lot of people were getting fired because Congress wanted to hold one person accountable, but they really couldn't because there were multiple program offices that were building the helmet, building the computer for the dashboard, building the wingtail, building the tire, so just trying to relate it, make it relatable, and take the information out of the abstract, right? Then we have zero-based budgeting, and it's exactly what it says. You start from ground zero every year, all the time. And yeah, you're very methodical, very meticulous. You pretty much literally bin counting. That's the strength of this, is you can rebase every year. And of course, the weakness is the strength itself, where it becomes lengthy, it becomes burdensome. You can't really pinpoint, or it's practical. It becomes impractical sometimes to really do a true zero-based budget. And then, of course, the last technique we have here, your standard cost budget, in which again, it requires the should cost, right? It kind of gives the quote unquote, this should cost this amount. And essentially it's good because you'll provide a goal for supervisors to meet right away, and financial personnel, currently attainable efficiency. Okay, well, this is our benchmark, or this is our standard cost here. We're trying to exceed it, try to find services around that. But then when you look at the weakness, again, very similar, is lengthy, and the standard itself needs to be updated depending on how the market changes for that product, for the cost of the product or the service that we're trying to position ourselves to pay for. All right, so we go to slide number 27. So here we're going to talk about capital budget principles, and essentially, like the word it says, capital. Again, to think big. Process of identifying, prioritizing capital expenditures defined by the organization. So for those of us that have been at MTF, so Navy MTF, this is where we talk about equipment procurement review committee, EPRC. Or if you want to buy a big equipment, X-ray or a lab analyzer, or install the baby monitoring system for the hospital. Well, that's a capital expense because it's going to be very expensive. So here, so that's an example. It includes land as well, but land is not for resale, right? Land is not for resale. That's the land, buildings and equipment. And again, all this comes back to that strategic plan, right? The long-range financial plan has to capture what capital expenses we're gonna invest in. And of course, as we invest in it, the intent is to try to find out, okay, for every money we spend, right, we do that liquidity ratio, not the liquidity ratio, but we go back and measure the ratio of, okay, for every dollar we're spending on these capital items, you do your capital structure ratio as well. And that's how it's all connected. And of course, you consider the opportunity, the risk, and inflation factors that go along with that. Okay. So here we'll talk about, on slide 28, we'll talk about, just for your familiarity, the discounted cash flows, which is pretty much a method that is used to estimate the attractiveness of an investment opportunity, right? So before we make the purchase and spend that capital, that huge amount of money, well, how about we discount the cash flow to see exactly if this is valuable, if this is worth the money being spent. And it essentially makes projections to determine the present value used to evaluate the equipment or the investment item itself. So that's pretty much a discounted cash flow. It just gives you a projected picture of, okay, is it worth the investment, right? Or you have your IRR, your internal rate of return, which essentially is the company's, the firm's rate of return internally to the invested capital. So on a discounted rate, it shows the present value, and then it also projects the expected cash inflow with the net investment outflow. So how much you've paid right now, that's the net investment outflow. That's money you've spent. It's going out. So compared to the money that's going out over time, how much money is going to come in, of course, plus or minus 2-3% for inflation as well. And then, of course, your net present value pretty much looks at the present value of the cash inflow and then subtract the investment cash outflow. Again, it's all about how much money is coming in, how much money is coming out, what's the delta. That is it going to be in the positive or is it going to be in the negative, right? If it's greater, absolutely. Anything that is always in the positive, 2 thumbs up, like 4 thumbs up without 2 big toes, if you can. Anything that is always a negative relative to what you're measuring, of course, you reject that. And sometimes when it's 0, folks can be indifferent. But why go 0 when it's still you're not making anything? So what's the point, right? You're barely breaking even. So that's essentially what this offers us. Okay, so go to slide number 28. Okay.
29,
I'm sorry, 29. I'm sorry?
It's Melody. It was 29.
Oh, thank you. Yeah, 29. And then, so here we have our reimbursement methods. And then we'll talk about, so per diem. So essentially, this is showing how a healthcare organization gets reimbursed, right? Or based off per day cost or cash payments for traditional fee for service, And of course, the insurance pays the fees. There's usually no risk here because we have our DRG, which is all developed and managed by Medicare as part of the prospective payment system. Here is based by the ICDs, International Code Diagnosis Procedures, etc. And the risk here is normally to the institution and not necessarily the physician. And then you have a capitated cost as a form of reimbursement, which comes down to the cap, right? So it's normally not the volume, but really the function is all about the number of subscribers um, to that service line per se. Okay. All right. We go to slide number 30. Hello. Okay. So here we talk about cost-based reimbursement. So essentially, look at the historical data to establish those reimbursement rates. And the thing with cost-based reimbursement is to ensure that, of course, as a firm, again, depending on inflation and accounting for present value of the service provided, the CFO accounts for that as well. And that's where we talk about historical cost for inflation to establish a reimbursement rate. All right, we go to slide number 31. So here we're talking about financial controls and auditing, all right? Which is for every money spent in an organization, you have to have a control. We have to have audit of some form to show the SEC, because the SEC will come to look at our books. And just as much as we print out a financial statement, they also ask for, okay, so who's your auditing firm, or who does your audit every year? And that's where you have your PricewaterhouseCoopers and your Ernst & Young folks and as such. No, PwC is no longer in service, actually. So that's more like Deloitte and Ernst & Young per se. So the control environment. So here we're looking at several factors that can impact positively and negatively an organization's internal control, right? So what's the philosophy of a governing board? The operating style. What was the organization structure? Function of the governing board and its committees. Particularly the audit committee. Methods of assigning authority and responsibility. Do you have segregation of duties? Was the management of governing board's control method for following up and monitoring performance? Personal policies and practices, and of course external influences that can affect the organization's operations and practices. So that's a control environment when it comes to financial controls and auditing. Slide 32. And then here we talk about the accounting system, right? And for an effective accounting system, it must identify and record all valid transactions. Again, going back to that matching principle, right? That is by the GAAP, the general acceptable accounting principle. Everything has to match. You got to identify what goes out, debit, what credit is coming in, et cetera. The financial transactions on a timely basis. And because it's timely, they're done in an appropriate manner, and it's in a time period. It's in that time period in which the financial transaction occurs. And of course, you adequately do your disclosure where needed or as applicable on the financial statement. Slide number 33. So here, when we talk about control procedures, we're talking about, in addition to the control environment and the accounting system, this gives reasonable assurance. That's the key word here. It's all about reasonable assurance that specific organizational objectives will be met, that no matter what, a reasonable person could come into the reasonable organization and see that, well, you have reasonable standards that you're applying to your control environment, to your audit principles. So here we're talking about, your proper authorization, as I mentioned earlier, segregation of duties, meaning the same person that may be writing the check is not the same person that is signing the receipt, and not the same person that is receiving the goods, and not the same person that is issuing the goods, or the service per se, auditability, from the minute we put it in the cost system or we obligate that, we initiate that transaction to when that service or product is delivered and provided to the firm or to the healthcare organization, it has an audit trail, and of course, just safeguarding of assets. And you can do independent review of other procedures performed as well. All right, slide 34, please. So here we talk about the capital funding sources. As I think I mentioned this earlier when we were talking about capital budgeting. Again, how do you finance capital expenditures? Really, um, for us in the, you can finance it through funded depreciation, philanthropy, i.e., for non for profit, they get money from the organization, or community rather, or a big donor. You can go into debt, right? So if you have a good ratio, you've done your attractiveness, your net present value was the IRR, discounted cash flow, all that good stuff. You've done it. Okay, we're going to take out some money to borrow and finance this extra machine or this GE system to, provide a service line for mammography because we know we're going to get a million or, pardon me, 80,000 patients. We've done the variable cost, all that, and we should break even within 3 years, et cetera, et cetera. Taxable leases, non-taxable leases, depending on whether it's for profit or not profit. Of course, you can fund it through operating surplus. If you have revenue minus expense, you get that equity. You can put your equity money here as well, or taxes for government entities. You can, based on what you get back on tax for a firm, they can use that to also fund capital projects or capital expenditures. All right, slide number 35. So here we talk about depreciation, and we have to account for depreciation. As soon as we buy that equipment, just as soon as we buy a car from the parking lot and we drive it off, it's already depreciated some value of some sort. And essentially, it enables, it is on the financial statement because you have to account for depreciation. And there are two ways to do it, or three ways. Primarily, the first two is, the declining balance, so depending on depending on the calculation used is to reflect on the financial statement. And the way of calculating when you do your declining balance essentially is subtracting a certain percentage of the current value each year. So depending on how much the asset cost and what the value or percentage of depreciation is assigned to it. So that's how you do the costing over the years of the equipment item or the capital expenditure item. Or you can do a straight line depreciation where you look at the depreciable amount, cost minus salvage value divided by the useful life. So, and we'll do some math here shortly to show that. Or you can do your sum of years in digits. So that's another method where you take pretty much the 5 years, if it's 5, 4, 3, 2, 1, you sum it up and you take the amount of the amount of the item useful for 5 years divided by the depreciation sum, and you have a depreciation expense which will be reflected in your financial statement every year. Okay, slide number 36. So here we're going to talk about revenue generation for healthcare organizations or for organizations. And the first one we'll talk about is accounts payable. Accounts receivable rather, sorry. So account receivable, which is a function of the production cycle and the payment cycle, right? So here it's all about, it's to reduce the collection period as much as you can. So yeah, when I was in Nell Hospital, Okinawa, I was privileged to work in a uniform business office, and yeah, I had no idea that we could actually charge. This is my first assignment as a junior officer, and that's when I learned so much about military treatment facilities. Actually, we do charge other health insurance, and we do charge being the fact that we're on Okinawa and the only U.S. not the only U.S. government or healthcare delivery system to provide healthcare services to U.S. citizens. So the contractors we had on the island, we were just another hospital for them to provide the service, and we had to charge them. So accounts receivable was huge for us because we wanted to make sure we captured the revenue cycle within 21 days. So our goal was to no more than 21 days was the benchmark per the instruction for the revenues from when the patient comes in the hospital, whether it's an ER, whether it's a regular appointment, to the RVU being captured, to the coders coding, to the bill dropping, to get into the insurance. We needed to do that within 21 days or less so we could capture, because anything after 21 days for us was like, oh man, now it starts going further out, and you start getting on reports, and you start having to report up and try to track down insurance companies and call the United States to Blue Cross Blue Shield and et cetera, et cetera, et cetera. So why I'm saying that is because that production cycle starts when the patient shows up to see the doctor, not after the patient leaves, not after the coders get get to coding. As soon as the patient comes in the hospital, the clock starts ticking. So the essential there is to try to minimize that time between when they get seen to when the coders code and it goes to the insurance firm to get paid within 21 days, which is quite ambitious, frankly. But that's the industry standard, if I'm not mistaken. So what you try to do is to ensure that the management accounting system can provide prompt and accurate recording of those charges, because that's critical. That is the right charge, is rightly coded on time, and we can send it out to the OHIs or insurance firms to generate that revenue for the hospital, right? So all that entails, again, right accounting system, right recording system for prompt and accurate and recording of the clinical information, the coders making sure they do, doing the best as they always do to, code appropriately for the revenue, and then sending it out to get the revenue for the hospital. All right, on slide number 37. So another revenue generation means is the credit and collection policy. And again, this has to be approved by the board, which directs how the organization will manage extending credit or collecting the accounts. So here you're talking about, okay, it should address, charity care. So what's that portion of the financial statement that we already decided, this is the amount of charity care figure we're going to do for this year. The bad debt, third-party insurance policy relationships. The credit policy has to address each, billing procedures, deposit procedures, so, this is where having that credit and collection policy as a healthcare organization really enables and shows how the organization will execute their services when it comes to credit and collection on these different issues. Okay, slide number 38. So here we see the production cycle of billing. So you have the pre-care, right? It comes to the hospital. You have demographic info, insurance, verified coverage, whether it's a D2569, TRICARE, OHI, whatever it is, obtain the authorization, deductibles and copays collected as needed, and they now go into the care phase. So after they get the care, the charges are recorded, right? Medical record is already in record. They review utilization, and then once the care is completed, so here we're talking about analyzing abstract medical record. You code it, transcribe dictation as needed, get the physician attestation, right? And then of course the payment cycle is where you print the bill, submit the bill to where it needs to go, and follow up on it. You collect it. And of course, the revenue comes to the hospital. So this cycle essentially is where the 21-day clock is. You're trying to, I think for overseas it was 14 to 21 days. For Konos, I believe it was 7 days, if I'm not mistaken. I have to look up the DoD instruction again. But that's essentially what the revenue cycle or revenue generation looks like for the healthcare organization. All right, slide number 39. So here we talk about cost finding and cost allocation, which is the process of, here we're trying to pull that indirect cost to a specific cost object using an allocation base, right? So a lot of times for firms, this is where we see, like for linen or for laundry is a quick one. It belongs to housekeeping, but housekeeping takes care of the whole hospital. We clean the wards, we clean the clinical areas, we clean the non-clinical areas. Like sometimes we clean outside, depending on where we're located. So how do we try to allocate the costs of laundry and the cost of linen to the nursing and to the radiology department? Because again, we're providing those services across the board to the hospital. Even though we're non-clinical, how do we do like a step down? So that's where you talk about step down revenue. So you take the non-revenue departments and you allocate their cost across, kind of spread it out among the revenue or allocated among the revenue generating departments per se. All right. So slide number 40. So here we talk about direct apportionment. So here you take that one-time allocation from a non-revenue generating department, and then you attach it to it is one time. So, hey, okay, housekeeping. You know what? I'm just going to take you and roll you up on the general surgery clinic. There you go. Or you do a double apportionment, where it's the same aspect. After one allocation sequence, right? You distribute it to two separate places, one service, but divided to two separate places, two separate departments to receive the cost, right? Or you do multiple apportionment, which is again splitting it depending on how the non-revenue department provides services to revenue departments. You split it accordingly, multiple allocations before the final allocation is done for the entire hospital. So it just all depends on what the service that's provided by the non-revenue department and how you allocate it, whether you do a one-time allocation, direct apportionment or double apportionment, or you do multiple apportionments across the hospital. Okay. All right. Slide 41. So, in summary, we spoke about the basic accounting principles. So if you can remember, like at the top of the hour, we're talking about, the SEC being any government, any business in America has to follow SEC rules, Security Exchange Commission. Security Exchange Commission, they follow FASB, the Financial Accounting Standard Board helps them out. Healthcare Financial Management Association helps SEC, as well as the American Institute for Certified Public Accountants. And of course, the GAAP principle, right? The generally accepted accounting principle is what monitors the financial statement, right? So when we spoke about the financial statement, we're talking about, again, remember we spoke about the income statement, which is similar to our checkbook. We spoke about the balance sheet, and then we spoke about the statement of cash flows, which shows the cash of the organization. So when you talk about income statement, as it says, essentially your revenue minus expense. You have your revenue, you have your expense, you have your net income or your profit, right? And then we spoke about the balance sheet, right? Where the balance sheet, there you have your total or your current assets or total assets minus your current liabilities, total liabilities, which gives you your equity or your residual. We spoke about that. And then, of course, we spoke about the statement of cash flows, where you talk about your cash financing from financing activities, your operating activities, or your investment activities, which shows how you do cash in your organization. We spoke about the matching principle, right? Remember, for every debit, there's a credit, right? Which is accrual accounting. That's what it's all about. For every debit, there's a credit. That obligation, it has to be specific to a time period. It has to be relative, comparable, objective, right? You put your self-disclosures on your forms, on your financial statements. And we spoke about the activity ratios and what that means. Again, remember, it's not about the calculation itself, but knowing exactly what your ratios mean. What is the activity ratio? What is your capital budget ratio? Or what is your operating activities ratio? Just to understand what it means for the stakeholders, which more than likely are investors trying to invest in a firm, right? Spoke about reimbursement methods. Spoke about per diem, right? We spoke about we just went over the revenue generation cycle, right? So we did that. We spoke about how the budget really is a translation of the operational plan for your 1-year operational plan, which informs your 5-year strategic health, 5 years strategic financial plan, right? Which involves your 10-year strategic plan for the whole organization. So we spoke about that, right? I spoke about our capital funding sources. How do we find money to fund capital expenses? We spoke about taxes. We spoke about debt. Financing. We spoke about philanthropy as well as some of the means of doing that. Taxable leases. All right. So I think that's a good summary. So what we're going to do next, over the next couple of slides, I have some review questions for us, which will encourage us to participate. So our first question is, which of the following, so this is slide 42, which of the following is an example of a capital expenditure? And forgive me, I cannot see the responses, but I would allow Melody to let me know.
So it looks like Craig has answered letter C.
Letter C, absolutely. A building with a useful life of 20 years. That is a capital expenditure. Absolutely. Absolutely. All right. Slide number 43. So here we talk about which of the following is an example of an asset. Remember, an asset, which is on the plus side of the balance sheet. Which of the following is an example of an asset?
Okay. I've got Craig, Jackie, Felix, all answering letter D.
Absolutely. It is the letter D. Your property, your plant, and your equipment are your examples of an asset. And keep in mind, again, understanding the ratios that go with that, whether you're trying to finance it or your capital budget ratio or your liquidity ratios, right? So, fantastic. All right, we'll go to slide number 44. Wow, okay. What does a liquidity ratio measure? What does remember liquid water? What does a liquidity ratio measure?
Okay, I got 3 letter A's.
3-letter, absolutely. The firm's ability to meet its current obligation in a timely manner. And whenever you see that word timely manner, they're probably talking about 90 to probably 3 to 6 months, like probably more than likely within 3 months. That's what they're looking at for the most part. But absolutely, it's all about how can you meet that in a timely manner, liquid water. All right. So our next one, okay, we'll do a little math here, and we can do it. So Memorial Hospital offers a screening test as a public service. So let's take a screening test and let's put COVID test, right? Memorial Hospital offers a COVID test as a public service for 50 cents per test, right? So that's a 50 cents. So 50 cents becomes the CM, right? The cumulative margin, right? Contribution margin is 50 cents. So the variable cost, right? So whether it's swabs, cotton, the variable cost per unit is 32 cents. So out of that 50 cents of the contribution margin, 32 cents is your variable cost, right? And the fixed cost, no matter what, the building, the table, the chairs, the water you're going to get, the cookies, whatever, is $43,200 per month for the department performing the test, right? So we have our contribution margin of 50 cents. We know what our variable cost is at 32 cents. And we know what our fixed cost is for 43,200 per month. All right. And it's the only test done by this special department, which is called the COVID department. So what would be the break-even point? So at what point or how many tests do we have to do in order to break even for our profit margin? All right.
Okay, so looks like we have a couple of letter A's so far.
Outstanding. It is, yes, 240,000 tests because, again, we take that, 50 cents, deduct the 32 cents, right? So we know what our cost is there for about, and we already have our volume divided by 0.18 cents, and we have to do 240,000 tests. Outstandable. All right. Okay, number 46, slide 46. All right. So it's this one. So controlling the cost of accounts receivable, right? Controlling the cost of account receivable is heavily affected by which choice? Remember what? So if you think about the revenue generation, right? We already saw the patient. We have that revenue generation cycle: pre-care, the care, post-care, and receiving the payment. So
right.
we have. All right, what we got?
Popular answer is A.
Popular answer is A. Exactly. Remember my story: 21 days or less. Yeah, absolutely. So you want to control the time or length of the payment cycle. All right. Okay, 47. For information on net cash, cash flow is the word, from providing health services for a specific time frame, the decision maker should use which of the following financial statements? Remember, this is cash.
I've got 1A and 4Ds, 5Ds.
Okay. All right. So yes, so it is anything that says cash is always statement of cash flows, no matter what. If you see cash in there, the net cash, cash flow. You know, of course, your revenue minus expenses, your income. But whenever you see the word cash, just always think of the statement of cash flows. All right, we'll do a little math here. Just straight line. Oh, well, okay. So on the 1st of January 2016, Alpha Hospital purchased a CT scanner costing $1 million. The company is going to use the CT scanner for 8 years. So for 8 years operational, it will be used, at the end of which it can be sold for $150,000. So what is our calculation for depreciation each year? So remember, now we already know it's $1 million. And we already know that it will be used for 8 years, right? So, and we already have our salvage value. So per year, how much are we going to have to depreciate to show this on the financial statement?
Okay, Bill answered with 106,250.
Absolutely, 106,250. Absolutely, and again, we already have that $1 million as a cost by minus 150 divided by salvage value. The salvage value divided by 8 years. Absolutely. All right, these are my references that I used. The ACHE Finance Reference Manual. Mr. Nowicki, 2008, a little dated. However, the core, I think, is on the 5th edition now, but the material is pretty much the same when it comes to financial principles and accounting. And of course, the mighty United States Air Force ACHE Board of Governors Study Guide, which is pretty still relevant till today. So those are my references and readings that I use for our material today. And lastly, I wish you all the best on the Board of Governors exam. You will rock it, and you will do awesome. And I can't wait to hear about everyone convocating at ACHE. That'll be amazing. So that's all I have for us. I will stand by for any questions from anyone.
Hey, Temmie, it's Melody. You had one more question on statement of cash flows that.
All right. Oh, sugar cookie. Outstanding. I sure did. All right. Statement of cash flows is typically organized into 3 sections: cash flow from operations, cash flows from investment activities, and cash flow from bad debt, regulatory recapture, financing activities, or donations and foundation support. I wonder that answer will be.
Got a bunch of C's.
Outstanding. It is the statement, cash flow from financial or financing activities. Absolutely. All right. Well, so I'll repeat myself. All the best on the Board of Governors exam, and standing by for any questions anyone has. And thank you for this amazing opportunity. It's always a pleasure.
Okay, Luke, do you want to go ahead and open your mic and ask your question?
Hi, Luke Richmond here. Sorry, I'll just be honest. My kids ran in here and were so loud, and I completely missed the end of the depreciation question. I saw the answer and I heard, yes, that's right, but I don't understand why that's right. Could you go over that one more time?
Absolutely. So let's do this. Let's go to, just to give you the, so we go to slide number 35. So on slide 35, with that question, what we did, the method we used was the straight line depreciation. in that we already know is $1 million, right? So the depreciable amount is already identified. The cost is $1 million, and we already have the salvage value, which would be 150 divided by the useful life of the equipment item, right? So the cost is $1 million. The salvage value is $150,000, and then we divide that by 8 years. So at 106, 250,000 per year, that's the amount we're going to place on the financial statement to show that this item is depreciating for the next 8 years until the end of the life cycle. Does that make sense?
Yes, thank you. Thank you.
Oh, you're welcome. You're very welcome. My pleasure. My pleasure. And just for everyone's uh, situation awareness. So when you do depreciation, right? So that cost 106,250 is going to show on the statement of cash flow. So in the statement of cash flow under the operating activities, because we're using that CT scanner for operations of the hospital, operating activities of the hospital, i.e., we're shooting scans every day. Once we get that value, we're going to now bring that value from because it's not a it's not a revenue or an expense, right? So we can't put it on the income statement. It's not on the balance sheet because it's not a yes, the CT scan can count as a total or a current or rather a total asset, right? It could count as that, but because we're now valuing the depreciation itself, we're going to bring that cost and show it on the statement of cash flow, specifically under the operating activities portion of the statement of cash flow. Okay. All right. Any other questions?
Hey, Temmie, this is Tracy. I know last time there was a pretty good discussion about goodwill,
Yes.
but we didn't really get into it this time. Would you mind talking about that real quick?
Absolutely. Absolutely. So the best way so with goodwill. Okay. So when we look at the not the statement of cash flow, when we look at the balance sheet, right? Goodwill is normally under the current asset, right? And essentially what goodwill is an intangible asset, right? That is associated with the purchase of a company by another company. So essentially is in a situation where the purchase price of the firm is higher than the fair value of all the visible solid assets and intangible assets purchased in the acquisition. Okay, so let me take it down. Let me break it down. So say we want to buy Google, right? Everybody knows that you can count all the Google buildings in the world and their desks, their chairs, their buildings, their plant, their property, their equipment. No matter how much that plant, property, equipment, and every asset Google owns their goodwill is going to far outweigh what their physical assets are. The sum value of their visible assets, solid and intangible, right, is going to outweigh that cost, right? So instead of us buying Google for $1 billion, quote unquote, for its and giggles, I'll be like, you know what? I'm going to go above and beyond and buy Google for $5 billion or $3 billion, right? So automatically on my balance sheet, that's what is going to reflect is the $3 billion purchase, because even though I know the fair market value could have been $1 billion per se, and the fair market value of his liabilities is maybe $500 million, well, the purchase price is still going to go over the delta of the fair market value of the assets and the market value of liabilities. So that's where the goodwill comes in, right? Is the brand name, is the customer base, is the customer relations, is the employee relations, and everything that goes with that. So that's where goodwill comes in. Is the you try to monetize, or is trying to monetize the intangibility, the unseen of the asset. Is saying, because I am Google, I know I am worth this because of what I bring into the market. And the market, most of the time, the market is what evaluates goodwill, right? Frankly speaking. So if you all remember when Facebook first came out as a stock, I mean, it was off the roof because everybody was looking forward to that stock because that was the first time being an IPO. So the goodwill from not being an IPO for so long was so good that by the time they became an IPO, their projections were off the charts until now, where they just had their first loss within the last quarter of several $billion per se. So that's where goodwill is. Goodwill is kind of the space between how much I physically can pay for something, but because that something has so much more value other than the physical assets or intangible assets, the space between the intangible assets of the value and the physical value is where your goodwill is. The goodwill comes in between that space. So to capture that, it's an asset that is captured on the balance sheet. That make sense?
Thank you, Tammy. That was great.
Okay. Thank you, Tracy, for bringing it. It's funny you said that because I actually had that note on my slide from the last time. So thank you. All right. Okay. Any other questions? Okie dokie. Well, thank you so much. I really appreciate this opportunity, Tracy. Thank you, Melody. Thank you, everyone. And I wish everybody the very, very best on the exam once again, and standing by to support.
Thanks, Temmie. You have been phenomenal this class and the last one.
Thank you. Thank you so much.